Dear students, I am going to discuss about Higher Corporate Accounting Subject Unit 1 presented by Dr. P. Balamani, Associate Professor of Commerce BA, Vellalar College for Women, Erode. In this Unit 1 consists of amalgamation, absorption and external reconstruction. In this first one, amalgamation. What is amalgamation? When two or more existing companies combine together to form a new company, it is amalgamation. All the combining companies are liquidated. A new company is floated to take over the business. In other words, amalgamation refers to a case where two or more existing companies come together to form a new company. These existing companies transfer their businesses to the newly formed company and they go into liquidation. In amalgamation, a minimum of two companies go into liquidation. These companies are called transfer companies. One new company is formed to take over the businesses of transfer companies. It is called transferee company. In amalgamation, one new company is formed and a minimum of two companies are liquidated. Reasons for amalgamation. Normally, companies engaged in similar business may decide to combine their businesses to achieve economies of large scale operation, to avoid competition among themselves, to face the competitions from other entities more effectively, to eliminate or reduce office and administration overheads and avoid duplication of sales promotion and distribution activities. Sometimes companies may come together to get the benefits of backward or forward integration. A steel mill buying a mining company is an example of backward integration. What is forward integration? Same, a steel mill buying a company producing flat and long products and wires is an example of forward integration. Next one, we are going to discuss about absorption. What is absorption? When one existing company takes over the business of one or more existing companies, it is absorption. The companies whose business is taken over are liquidated. No new company is formed. In other words, absorption refers to a case where one existing company called transferee company takes over the business of one or more existing companies called transfer companies. In absorption, no new company is formed, but a minimum of one existing company is liquidated. Next one, external reconstruction. When an existing company is liquidated and a new company is formed with the same shareholders to take over its business, it is external reconstruction. Sick companies. Normally, sick companies with accumulated losses usually undergo such reconstruction. External reconstruction is also covered under the scheme of amalgamation. A company may have accumulated heavy losses because of adverse business conditions and poor management. Now, the business conditions may have turned for better or under a new management, there may be hope to revive the business but under a different name. So, one existing company is liquidated and a new company is formed with a new capital structure. So, closing an existing company and forming a new company to take over its business is called external reconstruction. So, in external reconstruction, one company is formed and one existing company is liquidated. Reconstruction of a company involves reorganization of its financial structure. If the reorganization is accomplished without liquidating the company, it is internal reconstruction. When reorganization of a company's financial structure necessitates winding up of the company and flotation of a new company with the same assets and shareholders, it is termed as external reconstruction. External reconstruction involves only one existing company and formation of a new company is mandatory. which is not the case with amalgamation when one existing company absorbs another existing company. Next one, we are going to discuss about differences between amalgamation, absorption and external reconstruction. In this first one, amalgamation, meaning two or more companies are wound up and a new company is formed to take over their business. But in absorption, in this case, an existing company takes over the business of one or more existing companies. In external reconstruction, in this case, a newly formed company takes over the business of an existing company. Next difference, minimum number of companies involved. In amalgamation, at least 3 companies are involved. In absorption, at least 2 companies are involved. In external reconstruction, only 2 companies are involved. Next difference is number of new resultant companies. Only one resultant company is formed. 2 companies are wound up to form a single resultant company. In absorption, no new resultant company is formed. In external reconstruction, only one resultant company is formed. Under this case, a newly formed company take over the business of an existing company. Next difference is objective. In amalgamation, amalgamation is done to cut competition and reap the economies in large scale. But in absorption is done to cut competition and reap the economies in large scale. In external reconstruction, it is done to reorganize the financial structure of the company. In last difference is some of the example for amalgamation, absorption and external reconstruction. A Limited and B Limited amalgamate to form C Limited. It is an example for amalgamation. Absorption, A Limited takes over the business of another existing company B Limited. It is best example for absorption. Next one, B Limited is formed to take over the business of an existing company A Limited. It is example for external reconstruction. Some important note, accounting standard for amalgamation is AS 14, that is accounting standard 14. The accounting standards committee of the ICAI, Institute of Chartered Accountants of India, had developed AS 14 to bring uniformity in accounting for amalgamations in India. Some existing companies transfer their businesses to another company and go into liquidation. They are called transfer companies. Transfer company means the company which is amalgamated into another company, either new companies or an existing company taking over the business of other companies. These companies are called transferee companies. Transferee company means the company into which a transferor company is amalgamated. Next one, we are going to discuss about types of amalgamation. Amalgamations fall into two broad categories. They are amalgamation in the nature of merger. Next one, amalgamation in the nature of purchase. Amalgamation in the nature of merger. An amalgamation should be considered to be an amalgamation in the nature of merger when all the following conditions are satisfied. The first condition, all the assets and liabilities of the transferor company become the assets and liabilities of the transferee company after amalgamation. Shareholders holding not less than 90% of the face value of the equity shares of the transferor company become equity shareholders of the transferee company by virtue of the amalgamation. Next condition, the consideration to the shareholders of the transferor company is discharged by the transferee company wholly by the issue of equity shares in the transferee company, except that cash may be paid in respect of any fractional shares. Next condition is the business of the transferor company is intended to be carried on after amalgamation by the transferee company. And last one is no adjustment is intended to be made to the book values of the assets and liabilities of the transferor company when they are incorporated in the financial statements of the transferee company. except to the ensure uniformity of accounting policies. In next class, we are going to discuss about next type amalgamation in the nature of purchase. Thank you everyone.